Straight line depreciation needs to be reported in the financial statements of the business. So how will we do that? Well, let's just go back and summarize how we do straight line depreciation. So what we're doing is we're saying the business buys a non-current asset, so let's say a van, and each period it buys that so it can use it to earn revenue. And when we buy the van, let's say it's $50,000, we say there's a big tank of economic resources which are unused of $50,000, in this case of a van. And then we do a ledger called van asset, and we would do a debit of 50,000. And that's not new. We've been doing that for months now. What we do is we say as each period goes, this van earns revenue. But we also need to say each period that it, or year in this case, that it earned revenue, we need to match it against an expense of using the van. And that was called depreciation. So each period we allocate the expense incurred, or depreciation, of using the non-current asset to earn revenue. And what we learned was we do a new ledger called depreciation of van, which is an expense. And then we also create another ledger because we are never ever going to touch the asset ledger. We're going to leave that, and instead what we're going to do is make another ledger called accumulated depreciation of van, and it is a negative asset. So if van's an asset, accumulated depreciation is a negative asset. And we're going to put all that, we're going to represent this accumulated depreciation as a big tank of used economic resources or expenses from using the van. So let's say year one went by, we had an expense of using the van of $10,000. So expenses go off on the debit side there. And then instead of putting it here as a credit to the van, like that logically could make sense. You go, well, it was a $50,000 van, I used 10,000 of it, so that should go there. We're not going to do that. We're going to put it here in accumulated depreciation of van, and it's going to start filling up in this tank. And because it's a negative asset and it's going up, it goes up on the credit side because it is the opposite of an asset. Now, at the end of year one, this expense account would be closed to the profit and loss summary account, and it would be reset back to zero. Year two goes by, we use another $10,000 of the van. So we'll do a debit to the expense, and then we'll accumulate another $10,000 of depreciation here. So now that's been used for $20,000. And what we can see is over time, between the van account and the accumulated depreciation account, we can say it's a $50,000 van, and we've used $20,000 of it. So really there's $30,000 of this van left. End of year two, we'll close this expense account to profit and loss summary, so it resets to zero. Year three, we use another $10,000 of the van. So we'll do a debit to the expense account, credit to accumulated depreciation, close the expense account to profit and loss summary, resets to zero. And finally in year four, we use $10,000 of the van, debit to the expense, credit to accumulated depreciation, close the expense account to profit and loss summary, so it's reset to zero. And we can see I had a $50,000 van, so that's this account here. So it's unused economic resources, and I've used $10,000, $20,000, $30,000, $40,000 of that. So between the balance of these two, there's $10,000 of unused economic resources left. So how are we going to report all this? So we've got three financial statements to prepare, and we're going to have to put straight line depreciation in them. And we've got the income statement, the balance sheet, and the cash flow statement. So let's just deal with each one at a time. So we'll start with the income statement. So when we look at depreciation, there were three ledgers. There was the asset account, the expense account each period, and then the negative asset called accumulated depreciation. So if we look at the income statement, we had all these sections. We had revenues, and then we lessed any sales returns, and that gave us net sales. The next thing we did was we took out the cost of goods sold, and that gave us gross profit. But we also said we want to plus or minus any adjustments for inventory. So inventory gains, losses, or write-downs. And that gave us adjusted gross profit. Then we had other revenues, so revenue earned from selling from sources other than selling inventory. And then we had this section for all the other expenses called other expenses. And that gave us a net profit. So we just look at our three accounts here. Well, there's an asset and a negative asset. In nowhere here does it say anything about assets, because assets will never go in the income statement. So we can ignore those two. So it's just this one. Depreciation of van is an expense. And let's look at our expense sections. It's either going to go in cost of goods sold, here in inventory loss or write down, or other expenses. So it's not a cost of goods sold. It's not required to get inventory in a condition or location ready for sale. It's not an inventory loss or write down, so it's going to go here. So long story short, in the income statement, depreciation will go in the other expenses section with things like wages, as you can see here, but things like rent, insurance, utilities, and so on. So income statement, depreciation will be another expense. Let's take the balance sheet. This is a little more complicated. So first of all, we've got an asset, an expense, and a negative asset. Expenses will never ever go in the balance sheet, so we'll get rid of that one. So now it's a question of how we're going to report this asset and this negative asset. So it's going to be recorded in the non-current assets section, but we're going to actually have to report three things. We're going to report the historical cost. And we've learned in other videos that that is all costs incurred to bring the non-current asset into a location and condition ready for use. And those costs must provide an economic benefit for the life of the non-current asset. So we've done that in a previous video. So we're going to put the historical cost. So for the van, that's 50. Then we've got accumulated depreciation, the total depreciation expense incurred during the non-current asset's life so far. And it basically represents the used economic resources of the non-current asset so far during its life. And lastly, we're going to have this new term called the carrying value. What does that mean? Well, first of all, just the mass of it. It's the historical costs less the accumulated depreciation. So it's this one, 50, less these numbers here, which is 40 in this case. And it represents the unused economic resources of the non-current asset so far. So in this case, we've got 50,000 less 40,000. So there is $10,000 of van still left. And why is it called carrying value? Well, it's basically the amount the non-current asset is currently being carried at on the balance sheet. So just using our example, what would that look like? Well, we've got a van ledger here. So we'll do our balance sheet extract. So we're just going to do the non-current asset section. I'm just going to do it for year 1, year 2, year 3, year 4. All right, so we bought a van. So when we bought a van, that was $50,000 of unused economic resources. So that would go here, and we'll just write van. And we said we are never ever going to touch this van ledger. We're not going to increase it or decrease it. So we'll actually put $50,000 for the van every year. So the historical cost of the van doesn't change. What changes is each year we accumulate some depreciation. And we're going to put that in a tank of economic resources which have been used, and it represents the expenses incurred from using the van. So in year 1, that was 10,000. So we're going to put that there. Now you can put it in brackets. I put it in brackets because it stands out and it says it's a negative number. It doesn't matter so long as the next number, which is your carrying value, balances. So it should be 50,000, take 10 is 40,000. And that's because mathematically the carrying value will always be equal to the historical cost less the accumulated depreciation. So in that case, that'll be 40. Then another year went by, we accumulated another $10,000 of depreciation. So now we don't write 10 here. So this is not period specific. It's saying what's accumulated over the whole life. So it was 10 in the first year and 10 in the second year, that's $20,000. So we can see that here, 10 and 10. So that must mean the carrying value, if I had unused economic resources of 50, but I've used 20, the carrying value is 30,000. Year 3 goes by, I'm going to accumulate another 10,000 here. So that's 10, 10, and 10. So that's a total of 30. That must mean the carrying value is 50 less 30 is 20,000. And then finally in that last year, we'll accumulate $10,000 more. So now I've used $40,000 of the van. So that is accumulated to a total of 40,000. So the carrying value must be 10,000. So that's how we'll report depreciation in the balance sheet. We'll have the historical cost, the accumulated depreciation, and this new term called the carrying value. And that just leaves the cash flow statement. So here's our ledgers. We've got an asset called van, an expense called depreciation, and accumulated depreciation, which is a negative asset. So this one's really easy because there's nothing to do with the bank ledger here. Like we paid cash when we bought the van, but we're not talking about that now. We're talking about what about this expense here? This is actually a non-cash item. So the entries for depreciation do not affect the cash balance of the business. So you can see here that there's no reference to cash anywhere. So this is an expense, but it's not cash. So real simple answer, we will never put depreciation in the cash flow statement. And now we know how to report for depreciation for our 3 reports. So the income statement, the balance sheet, and the cash flow statement.